Good afternoon all, and thank you for joining us. We really do appreciate you taking time out of your day to spend with us. My name is Vito Dintrono, Yarra Capital Management's Chief Commercial Officer, and I'm delighted to welcome you to this afternoon's webinar with Roy Keenan, our Head of Australian Fixed Income, and Ed Weller, Senior Investment Manager and Co-Portfolio Manager for Yarra's Real Assets Equity Strategy. Today's session marks the 12th in a series of updates from our team and forms part of our commitment to providing you all with access to our people and insights as we work our way through the COVID-19 pandemic. Very shortly, Ed and Roy will provide an update on the firm's observations on the hit to income as a result of COVID-19 pandemic and how this is impacting our assessment of both yields and valuations as we see income generation playing out in a post-COVID-19 pandemic world. Before we get started, just a couple of housekeeping items. You're listening to this webinar using your computer system speaker by default, and all participants are in listen-only mode. Just a reminder that questions can be submitted at any time by typing them into the question pane. Just look for the question mark symbol and we'll look to address as many questions as we can during the Q&A session at the end of today's presentation. With regards to the structure for today's meeting or webinar, firstly, you'll hear from Roy for about 15 minutes, then Ed for another 10 minutes, and we'll spend 10 or 15 minutes or so on Q&A before wrapping up a little after 3:30. And with that, I'd like to hand over to Roy Keenan. Thanks, Roy.
Thanks, Vito. It's a pleasure again to presenting in this forum. Hopefully today I'll take you through some of the opportunities in fixed income and sort of focus on what is really important in the current environment. With that, I'd like to probably start at page 4, and if I sort of reflect on my career and I think about the number of times that I've heard the phrase, "That's a great yield" or "That's a great credit spread," and I'd like $1 for every time that's happened. But what I'd like to do in this first slide on page 4 is actually show you that there's actually no such thing as sort of free money, and that from a risk perspective, it's pretty rare that issuers actually issue securities which are a compelling yield or a great credit spread, because most of the times the market doesn't misprice risk significantly. So with that regard, when we look at yield in fixed income today, and we look across even other markets like Australian shares and international shares, the one thing you've got to remember when you're actually, you are receiving yield is that you get compensated for a number of reasons, and the majority of those are risk. The risk of investing longer in term, the reliability of your coupons, whether it's contractual or they can be missed, overall credit quality of the security you're investing in, where you rank. Probably one of the things that's really mispriced is liquidity. And then when we start to move into the world of hybrids, we talk about things like ultimately your ability to be extended in the term that you invested, or ultimately conversion to equity. So when we look at those risk return opportunities in fixed income markets, we try to take all those factors in consideration to work out if a security is priced effectively. If we look at markets today on slide 5, we can see that today's short-term interest rates in Australia are very much at historically low levels, with a cash rate at nearly 25 basis points and bank bill rates that are significantly below that 25 basis points. You can see that there's not much compensation for an investor to invest to the very short term. Historically speaking, investors have utilised term deposit markets to actually, as a sort of successful means to generate some income. And I would argue that that's been a pretty good strategy because the spread between historically bank bills and term deposits has been quite significant. Looking forward though, I would imagine that, one of the key things of moving into term deposits is that you definitely give up liquidity and the ability to exit that security, or you will get penalised by the issuer if you do decide to actually terminate your term deposit early. Obviously, the sizes, the ability to move size and the amount you can invest into term deposits is also one of those structural issues that will ultimately mean that you receive a lower yield when looking to invest in the short-term markets. I think although it's been a good strategy for investors, my view on term deposits over the medium to long term is that as banks adjust to COVID-19 and they look at their balance sheets and liquidity needs, I think ultimately what we will see in this marketplace is that the spread between short-term rates and term deposit rates will ultimately compress over time. So, the ability to actually generate a good short-term yield will start to evaporate in front of investors' eyes. We turn to page 6 and we focus on other parts of the fixed income market. And I think probably one of the things that, what I've tried to do is here on this chart is actually probably list the most popular avenues of generating income and yield through the Australian fixed income markets today. I think one of the most important things here when we look at these curves is that if an investor wants to generate a yield greater than 1% today in Australian fixed income markets, then they have to actually either invest in government bonds greater than 10 years, have to commit to a term deposit, of significant term, potentially up to 5 years, which ultimately will, mean that you're locking away your liquidity for a long period of time. And in the case of government bonds, if you're investing greater than 10 years, then that is a significant, call on where interest rates will be in the longer term. The other thing that we need to think about when we're talking about, that ability to actually generate those types of yields is to actually look at those risks. And one of the things that we're seeing today if you want to generate a return greater than 1%, there's not a lot of opportunity in the Australian market to do that unless you actually start to look at credit. And as you can see on that, the green line curve there, the AA- major bank paper, even investing into senior bank paper will only generate a return of greater than 1.5% if you invest out for longer than 10 years. So from our perspective, if we're looking to generate a return and investors need income that actually is greater than 1.5%, and they need that income to survive on, and then they really need to head to the more lower quality in credit, still investment grade credit of BBB-, and also the major bank hybrids, which you can see in the light blue line. Now, obviously, moving into those types of credit actually also introduces new risks into that marketplace, and I'll talk about some of those risks a little bit later on. But obviously, in the case that you start to move into those marketplace, you increase your liquidity risk, definitely your coupon risk, because there is some deferrability in especially hybrid coupons, although I see that as a very low risk, especially in the major banks. But you definitely start to introduce extension risk and convertibility risk. And the most important thing from our viewpoint is that the return that you're actually receiving as an investor compensates for all those risks. And we think today's market is starting to do that for investors. So if we turn to page 7 and we look at where we are today in the market, and I think from a perspective of long-term interest rates, and if I think about my career, I've been lucky enough to be a part of probably the biggest bond market rally in history, having started my career in the 80s. It has been pretty much one-way traffic with a few blips along the way where interest rates have risen. But I think the most important thing is traditionally fixed income investors have viewed, especially government bonds, as a defensive asset class. And I think probably where we sit today, there's no doubt that longer term bonds have definitely started to lose their defensiveness. People very rarely think about the mark to market in a security like 10-year bonds, but you are investing for 10 years. And if we say that, that today the 10-year bond rate is roughly around 1% and it was to rise 2% in a very short period of time, then we're talking capital losses in what we would view as defensive security of nearly, between 9.5% and 10% in 1 year. So that is quite to me, that doesn't seem to actually offer, the defensiveness, that we have historically seen from investing into government bonds. And hence, in some ways, our view is that investing for the longer term in 10-year bonds or in bonds in general of any duration starts to introduce significant risks that historically haven't been there. On the contrary, credit spreads, especially given the recent sell-off with regards to COVID-19, are starting to look more attractive and historically speaking are above their long-term averages. I've used the Moody's US BA credit index here. That has a long history. Unfortunately, in Australian credit, we don't sort of have indexes which have these, from a credit perspective, have these sort of longevity in credit spread history. But as you can see from this chart, that today with security, the credit spread on an investment grade US credit at over 350 basis points, you can see that it's significantly above its long-term average of 229. So we're actually starting to see some relative value in credit, and hence our view is in the current marketplace is that maybe the defensiveness of fixed income that historically has been viewed in 10-year bonds, we need to start thinking about how do we generate income but reducing that risk profile. And in our view, floating rate credit, where you don't have interest rate risk or the risk of interest rates rising, and taking on quality credit, which gives you that spread protection from rising interest, from basically potentially rising credit spreads, I think is probably one of the smartest ways to actually start to look to generate income now, but not only now, but into the future. If we think about, and we turn to page 8 now, and we think about the Australian market and how historically it is generated income. One of the things that that I often get asked about when I talk to people about fixed income and opportunities in the hybrid market or in other sectors of credit is that I'm constantly hearing from customers that their view on credit is I just buy 1 or 2 securities and I take much more of a direct approach. Given the risks that we've seen and heard about with regards to investing in credit, one of the worst things we think you can do is actually be too concentrated. So we think a much more diversified approach to credit is the way to go. Because if any of these risks of extension of, if coupons are missed, if you have a much more narrow focused direct approach, the actual overall impact on your income can be quite severe. Where if you have a much more diversified approach to income, not only can you source that income from many different sectors of the credit market, but the overall impact from something potentially going wrong is minimised through that diversification. I've been running the Yarra Enhanced Income Fund since about September 2002. One of the things that you would, it's quickly, one of the goals of the Enhanced Income Fund when we set it up many years ago was to provide reliable, stable income to its investors. And it's been quite remarkable that through that journey, and this fund has seen many cycles now and events, especially given the recent COVID-19 and prior to that, the global financial crisis. The one thing has been quite obvious through its history is that its reliability to generate consistent income, especially above the Australian cash rate. And over the journey, the fund has averaged around 291 basis points above cash. And over, the last, especially the last 5 years, it's closer to around 300 basis points above cash. So it's never missed a quarterly coupon, a quarterly distribution. And, I think, the product we designed, some 2002 has actually lived up to what it's meant to be doing, which is to provide income to its investors. I think if we look forward to, the page 9, and we think about how we're thinking about the market today from a COVID perspective, I think Tim Toohey, who's done many calls with our customers, investors over the last number of months, has pretty much called the response in COVID pretty well. From our perspective, that V-shaped recovery that we're seeing and the impact on growth and the government's response, in our view, has been timely, well received, and I think Australia as a whole has done a pretty good job in containing the virus, although we're starting to see some outbreaks in, especially Melbourne, in the northern suburbs. So, which is obviously a concern when looking at, any potential impacts from a second wave. The other thing that we are very focused on, there's no doubt the impact on growth in 2020 is going to be quite large, and we should see a rebound in 21. But there is no doubt the looming fiscal cliff in September will be important, not only for our decisions of where we're investing, but also how this will impact the consumer and especially small to medium-sized businesses going forward. The one thing that is undeniable is that interest rates, from our perspective, are going to remain low and low for a long period of time, especially in the short end of the yield curve, where the central bank today is targeting, the 3-year bond at the cash rate level of 0.25%. So we have the view that, there's no doubt that we will see the volatility we will see in interest rates will be pretty much in the longer part of the yield curve. That from our perspective, that's where, we think that the majority of volatility going forward will come from. From an Australian credit perspective, we've seen a market-wide sell-off in credit spreads. Today, credit spreads are probably 100 basis points wider on average where they were going into pre-COVID. The one thing from my perspective, and you probably shouldn't get excited from a pandemic, but the one thing that sell-off in credit has done for us is that we think it provides an environment for active credit managers to actually deliver significant alpha. And that's by doing the credit research, trying to identify opportunities where we think the risks that we've been talking about in this presentation, that you're getting compensated for. As I mentioned, today we view that the best place to invest, or it seems the safest way to look at investing into fixed income and generating income, is to actually to focus your attention more so to floating rate securities. I know, although our funds own fixed rate securities today, we have the view that we're hedging all our interest rate risk out, as we see the potential, and in some ways we're not compensating for taking on term risk or duration risk today. There is no doubt credit spreads are above their long-term averages, and we think this is a really good, if you have not been invested in credit, a good time to start to look at credit as an investment opportunity. What's keeping us busy today, corporate balance sheets are, look to be in great shape. But one of our key focuses today, from where we're looking to invest, is to actually focus on sectors that are potentially going to be impacted the most from COVID-19. And I've listed a couple of those on slide 9 there. Primarily, we talk about, office demand versus supply, will workers and companies, changed their attitude to their employees working more from office, or have we changed in culture to a more work from home environment? What is the impact on retail REITs and the patronage of especially retail shopping centres? The house prices in Australia has been quite interesting for us, and we think that although house prices have held up very, very well, some of the credit opportunities in RMBS and in some aspects of other segments of the housing market, where credit spreads are now providing you with an increase in credit spreads of 100 plus basis points, is actually starting to reward you for some of the risks of investing into RMBS. There's no doubt that consumer behaviour post COVID-19 is a big focus for us, as well as travel and infrastructure. And why are we so focused on this? Historically speaking, a lot of these sectors have been deemed to be low risk, defensive, and in some ways, as a credit investor, we've actually been focused on other areas because we felt a lot of the risk return opportunity investing into these sectors, as an investor, you weren't getting compensated. But in some ways, the credit spreads in these sectors, or the companies that issue credit into these sectors, has actually widened significantly and is starting to look very attractive to us, and in some ways is starting to reprice those structural changes that the COVID-19 pandemic has actually brought onto these sectors. And if I just quickly move to page 10, and this is a perfect example of how we've actually changed in attitude of where we're actually investing in today off this COVID-19 theme. Brisbane Airports came to the market in June. We looked at this security. Historically speaking, Brisbane Airports was probably never really on our radar as an investment. As you can see from its credit spread, it never gave you a large credit spread. It was trading at 100. The 2025 bonds, they were trading at in early February around 125 basis points. And from our perspective, to be investing longer term in still a high quality credit, but you weren't getting compensated from the perspective of credit spread. Or something going wrong with that credit. This is a similar theme that we saw across office, retail property, and in some ways RMBS leading into COVID-19. The one thing that we looked at, obviously with credit spreads blowing out quite significantly, Brisbane Airport is probably one of the more impacted credits that we look at. Their revenue has fallen substantially through this period. But the airport is not expecting any sort of recovery in their patronage or flights until well past 2021-22. They have significant liquidity. There's no doubt that Brisbane will still remain a significant tourist hub, and their exposure is mainly majority driven to domestic tourism. They have a really strong shareholder base who are quite willing to support their investment grade rating. So when we looked at all these factors, and yes, Brisbane Airport has been significantly closed or running at significantly reduced capacity, but we actually saw it as a very good opportunity, as the earning 350 basis points over in their recently issued bonds, as you can see on the light blue line there. Or roughly around 4.5% yield for the next 10 years. We saw that as tremendous compensation for the risks that that are currently embedded in Brisbane Airports. But we've got to remember, this is a long duration asset, which is going to be earning income from a long period of time. And we think it's, this is the time to buy this asset, and it wasn't the time to buy it back in January, February. And these are sort of the opportunities that we are trying to find out in the marketplace today to deliver, superior income for our investors. And with that, I'll hand over to Ed.
Thanks, Roy.
So just on slide number 12 now. So certainly from an equity perspective, it's been extraordinary 6 months, particularly if with the lens of dividends and the dividends companies have been paying. So we think that in aggregate across the ASX 200 dividends for the 2020 financial year been cut about 40%. And if we think about many of the blue chip yield stocks for the half that has just completed, will be paying either zero dividend or greatly reduced dividend. As you can see in the chart, as a consequence of this, the dividend yield on the market as a whole has fallen from what's been very consistent at 4.5% level over the last 10 years. Down to forecast of 3.1% for the year we've just completed. I think it is important to note that we don't see that as a permanent reduction, and I think that is important context as we think about yield investing in equities going forward. So across the equities team, we did bottom-up forecasts across all the stocks in the ASX 200 to try and build a sense for what the recovery profile will look like in dividends across the market, and what we can expect from dividend yields going forward. And based on current prices of the ASX 200, we do think that the market will get back above 4% dividend yield in the next 2 to 3 years. So whilst we're expecting a recovery, it is important to note that the recovery won't be uniform. There are some stocks and sectors that will lead the recovery. The example I'll give here is toll roads. So Transurban, obviously a leader in that space, they're already seeing traffic on their Sydney and Brisbane networks back to 90% of pre-COVID levels. And conversely, as you just heard from Roy, airports is an example of an industry that we'd expect to lag, and that recovery will take longer. And then there are also sectors where we would expect to see potentially some level of permanent reduction to the level of distributions, that they won't recover to where they were pre-COVID. And I think REITs is an example of that, which we might touch on a little bit further on in the presentation. Just over on the next slide now, on slide 13, and this chart shows the shift in the market's composition of yield. So the three sectors that I've highlighted in red, if we were to look at this chart 6 months ago, those three sectors would certainly be well over to the left of the chart. However, they have been obviously impacted by the disruption through COVID-19. So, for example, we would have seen transportation yielding in excess of 4.5%, REITs around 5%, and banks over 6% if we were looking back 6 months ago. It is worth noting, though, however, that not all sectors have been impacted by the disruption in a uniform manner. A couple of the sectors to highlight here, yield-orientated sectors being utilities, which has seen very limited impact. Our preferred play in that space has been APA Group, and telecommunications, which is obviously dominated by Telstra. And that has seen yields or dividends relatively unaffected, and if anything, that business has probably been a modest beneficiary of COVID. So I think one of the key points I'd make on this slide is that whilst every crisis is different, and certainly we hope in our lifetimes we don't see another global pandemic, it is worth noting that a portfolio approach to yield investing has been beneficial through this cycle, and I think through most cycles as well. Just over on slide 14 now, and to build on the points Roy was making earlier around the low interest rate environment expected to persist going forward. On this slide, we've got a chart of the ASX 200 dividend yield, less the 10-year bond yield. And what we can see, at least over a view of the last 15 years, it is that it's at a very high level. If we would extend this chart back further, you would also see that sort of where we were at the start of this year at least, was around all-time highs and a level not seen since the 1970s. So I think that context is important, is that the spread of ASX dividend yields over essentially a long-term risk-free rate is very high. Clearly, that's come back a little bit with some of the dividend cuts that we've discussed. However, given the recovery that we expect to come through over the next 2 to 3 years, we would expect to see, based on today's prices remaining constant, we'd expect to see the line on that chart continue to track up towards the top right. And I think, that does highlight that there are opportunities to invest today on what will be, very attractive yields, maybe not in the next 6 months, but as we look out 2 to 3 years. So just as a final slide for me on slide 15, and we can see on this chart, this is consensus dividend forecast for the 2022 financial year. There are a lot of some of those yield-oriented sectors that I highlighted earlier, have moved back to the left-hand side of the chart with yields recovering. So if I take banks, for example, in the near term, banks have been severely impacted at an earnings level by much higher bad debt levels, bad debt expense. We see that as actually around a peak now, so that will recede going forward over the next couple of years. And using reasonably conservative assumptions, bad debt still being above mid-cycle levels, bank dividend payout ratios being low by historic standards, about a 60% level versus historic more around the 80% level, you would still have a sector yielding in excess of 5%. If you were to take out CBA, the sector would be yielding in excess of 6%. And of course, that's on a fully franked basis as well, which is important. Transurban is a preferred play in the transportation space. We see, obviously, they'll be at the forefront of a recovery, and we also expect that they will have opportunities to participate in growth projects as governments globally look to stimulate local economies through infrastructure projects. Another name I'd call out in the insurance space is QBE. So QBE has a very strong capital position, having raised capital earlier in the year. They also have quite a strong fundamental backdrop with the global insurance industry going through a hardening pricing cycle. So that's another example of a company that has reduced dividends in the very near term. But if we look out on a 2-year basis, we can see that yielding 5% plus, again on a partially franked basis. REITs I touched on earlier. I think the COVID has probably accelerated some structural pressures that I think everyone was well aware of in the retail space. It's probably potentially created some structural pressures in the office space. That's something that's new, the two largest components of the REIT sector. So we do have some caution on REITs as a sector going forward. There will be opportunities definitely within that, but there is potential to see rents reset across the industry, in particular sectors, which will obviously lower dividend capacity. A final point I'd make before handing back to Vito on dividend yields, I think it is important in the context of the low rate environment that, if we look outside what are the traditional income sectors, we also see opportunities in what we'd categorise as high quality industrial companies. So just to pick a couple of names from our portfolios at the moment, if we think about a leading retailer such as JB Hi-Fi, that company has a dividend yield in excess of 4% today with strong growth prospects. A couple of healthcare related names such as Ansell and Sonic Healthcare, you categorise those as reasonably low risk companies, yielding around 2.5% dividend yields with strong growth prospects. And Coles being a major supermarket, again yielding around 3.5% dividend yield with solid growth outlook. So with that, I might wrap up and hand back to Vito.
Great, thank you, Ed. Time for Q&A. Quite a number of questions have come through, which is fantastic. Please keep them coming, and thank you for those. Roy, we might kick off with you. First question is, given the current level of short-term interest rates, what is the outlook for income distribution in future years?
Thanks, Vito. It's a good question. It's one thing I'm always focused on from a perspective of, what does, especially on a 1 to 2 year lookout, what is especially across all our funds that we made, not just the enhanced income fund, but what is the outlook for our distribution profile, and what do we need to actually generate to actually meet our targets? One of the pleasing things is that given, as I earlier mentioned, the majority of the securities we invest in are in floating rate, which, set basically off the 90 or 180 day bank bill rate. Given now that bank bill rates have fallen to below cash rates, the majority of our securities have actually reset. So if we take the view that longer, the short-term interest rates are here and they're going to stay at these sort of level for a period of time, let's say 2 years, it's pretty easy for us to forecast 1 or 2 years out because we've actually, we're getting to the low point of where short-term rates can fall to. So and actually forecast with a fair bit of confidence. So with that being said, today when I look at the fund from a 1 year out perspective, our running yield on our fund or our income generation is roughly around the 3% mark, give or take 10 basis points, which from a cash perspective is 275 basis points over cash. So that is historically, pretty much as you saw on that earlier slide that I had on chart on slide, I think it's 8. We can, we're going to be pretty much generating the same sort of income from the enhanced income fund as we've seen historically since 2002. And it's unlikely that will fall below that 275 basis point mark. For investors who are invested in, say, Income Plus or Yarra Absolute Credit, if I look at their, forecast yields looking out, once again, their forecast income and likely distributions to investors are well above long-term averages and meeting the target that we've set for those funds. So in some ways, from a credit manager's perspective, today's environment's pretty good for generating income.
Great. Just a follow-up question, Roy. Hybrids have recovered from their March sell-off. Do you see value in this sector?
Yeah, in some ways, Vito, hybrids have, not only recovered, it's been an exceptional recovery from that sort of third week of March when, credit spreads traded out towards 800 basis points to around 350 basis points where we are today. Such a big rally, but from our perspective, hybrids today still remain cheap, and that's sort of tier 1 and tier 2. My rule of thumb has always been that, to move from senior at 55 basis points where we see senior credit spreads today on, say, 2024 security, you generally want to be, to move into tier 2, you generally want double the compensation. Today, it's 4 times that compensation. So in some ways, and if we move into tier 1, which I normally say 4 times seniors where you want the compensation to be, it's more like 6 to 6.5 times the compensation of senior. So even though we've had this tremendous rally in credit spreads, I would say that from my perspective, both tier 1 and tier 2 hybrids, from a perspective of where we're seeing the senior bank bill, senior major bank bond spreads, are trading some 100 basis points cheap. And we're still attracted to both, probably attracted more so to the tier 2 than the tier 1, but, which are trading in the over-the-counter market. But, we do see the market is still remaining, pretty cheap, but sadly not as cheap as March.
That's right, thank you. I note we're running slightly over time, so Ed, we might finish off with 2 questions from you, if that's okay. And the first of those questions is, there won't be a distribution from Sydney airports this period. When do you expect I'll be paying a distribution again? And how long until it returns to pre-COVID levels?
Okay, thanks, Vito. It's a good question. In terms of Sydney Airport, the ability for them to pay distribution is really linked to the recovery around international traffic and passenger numbers. So at present, the bit like what Roy was discussing with Brisbane Airport, the Sydney Airport is cash flow negative. As we see domestic passenger numbers recover first, that will get them back around to break-even level. But you really are going to see international come back on top of that before the distribution comes back. So, our view, given what we know today, and obviously there's a lot of uncertainty, it's probably unlikely we see a distribution over the next 18 months. So it's really going to be into 2022 before we start to see distribution from Sydney Airport. Importantly, though, and again, similar to Brisbane Airport, Sydney Airport's balance sheet is in very good shape. They've got plenty of liquidity. Whilst they're cash flow negative, they're not really accumulating massive levels of debt. They've got credit ratings agency support, so they have no need to raise equity. So there'll be no dilution to the capital base. So as coming out of this, as it recovers, there's no reason why the distribution couldn't recover to pre-COVID levels.
Great, thanks. And one final question, and this question's come through in a number of guises, if you like, so I'll try and consolidate it into one question. Australian banks have long been the mainstay of equity yield investing. With dramatic cuts in dividends are those days over? And will they still be able to frank dividends?
Okay, so thanks. Yeah, again, a good question. I think as I sort of touched on in the presentation, we do see the bank dividends will recover, particularly as bad debts recede. Notwithstanding, we think it's unlikely they ever get back to the level they were, or the payout they had, say, in 2019, for example. So it's likely that banks will have a lower level of payout ratio going forward as well. That being said, the share prices have readjusted significantly as well. So the point I was making in the presentation, as we look forward, you can actually, if we sort of think about FY22 plus, you're probably buying them on a 6% plus dividend yield today. On the franking credits, obviously that's an important component. So that 6% would be fully franked. Even though the banks had a particularly tough time of it this year and taken very large loan loss provisions related to COVID, they're still all profitable. So they're still been generating franking credits, or at least not generating significant tax losses. So they will continue to generate franking credits going forward. I would expect the dividends would remain fully franked going forward.
Great, thanks, Ed. And that brings today's formal proceeding to a close, if you like. Thank you for everyone for their attendance and for your questions. Apologies, we're slightly over time, but plenty of interest in this topic. And we'll look to address the questions we haven't got to post today's session. If there are any additional questions post that, please contact myself, Nick Green, or Ramala Copium in the first instance to help, if not arrange a follow-up meeting with the various team members. I encourage you to keep an eye out for our next session running at the same time next week. Invite to come out shortly. And post today, you'll also receive a survey on today's presentation. Any feedback, comments, greatly appreciated. Finally, on behalf of Yarra Capital Management, a massive thank you for joining us. Thank you for your ongoing support, and have a great afternoon. Bye-bye.